You'll feel free to type in your questions in the chat, and I will do my best to weave them in as we go out through this presentation. And as we think about 2023, we have a lot of great things happening over here at ACUMA. We're excited to share them with you. Be sure to check out our website for all the latest and greatest news. Just looking at my notes, I think that's all I have for today as far as housekeeping goes. Let's get started. So today's ACUMA webinar is being brought to you by Sales Boomerang Mortgage Coach. Joining us today is Dave Savage, Chief Innovation Officer. Dave, welcome.
It's good to be here. How you doing, Peter?
Just fine, living the dream. Thanks for asking.
Right on.
Dave, I want to start by saying, in addition to the sponsoring today's session, to which, I'm extremely grateful that you guys did. Sales Boomerang Mortgage Coach is, an amazing supporter of ACUMA, our members, the credit union movement, and for that, thank you. And I keep thanking you over and over again, but again, thank you for being such a great supporter of us.
We love what you do, and we love helping families make better decisions.
That's right. I love that. All right, coming back to today's topic, New Year's resolutions for 2023. We pick this topic, because we often hear or read, what's going on in the market, the stats, the figures, the data trends, especially when compared to the last 2 years, we're experiencing an almost about face and volume. And it's about time that we start, it's about this time of year that we start focusing on new initiatives to better serve our members and grow our business, right? So, we thought it appropriate to hear firsthand, from our panel of experts on what credit unions should be considering in terms of the economy, the various regulations, what we need to consider when it comes to, focusing on building our business. Now, that brings me to you, Dave. I'd love to get your thoughts on a few things. Sound good?
Sounds good. Let's go.
All right, perfect. All right. So, for those attendees that may not be familiar with, Sales Boomerang and Mortgage Coach, and really the solutions you provide, how's Sales Boomerang and Mortgage Coach really helping credit unions put members first? I guess that's the most important thing. Member service, we're member first, member focused, member service driven. How are you helping us put members first?
Well, our entire mission is helping borrowers achieve financial freedom. We believe that people don't get loans because they want loans; they get loans because they want homes. And the true American dream is debt-free. It's financial freedom. And so our whole mission is to first of all, if someone can qualify for homeownership, to make sure they know it. That's why we have a rent versus own analysis. That's why we believe that giving a consumer a fee worksheet, here's your rate, here's your payment, and here's your cash to close, that helps them get into debt. That doesn't help them achieve financial freedom. That doesn't necessarily help them pick the right loan. So our vision, another big problem that we solve, no borrower left behind, is that most lenders and credit unions are not excluded from this. You lose more loans than you close. And let's face it, credit unions have incredibly competitive interest rates. They have incredibly great products and services. So we want to make sure that you, through data, can understand who's ready for a loan, who qualifies for a loan. And rate and term refis are not the only types of refinances out there. There's a lot of debt consolidation refinances, home improvement refinances, just cause-driven refinances. So through a combination of data and then digital presentations, we're well known as the total cost analysis. We have millions of families a year that make more informed decisions through that. So in a nutshell, Mortgage Coach and Boomerang together, we go from data, think of that as the lead, and
Right.
who's ready for a loan, to the presentation, helping families get the right loan at the right time.
No, it's just that. It's not just that, right? You hinted at it, so I want to focus on it a bit, right? Let's, and I'm thinking about some best practices in today's market. Being able to educate a borrower on the total cost associated with their transaction is really key to success for any originator, right?
Right.
So you hinted at it, you mentioned it a few times. Walk me through how you can make that LO's life a little bit easier by creating that custom cost analysis and providing that additional insight to their borrowers, to our members.
Well, the three most common ways in today's markets, we're in a market where rates are extremely high. They've more than doubled. And so we have an affordability crisis in America. And we had an affordability crisis even before interest rates doubled. So what you're seeing more than ever is you're seeing our total cost analysis being used to show buy down options. That could be a 2-1 buy down. That could be a seller paid concession buy down. That could be an ARM, but showing affordability strategies, showing down payment assistance strategies, showing different ways for a homeowner to achieve financial freedom with affordability strategies. So that's a very common scenario that's created with Mortgage Coach. Also, you're seeing a lot of loan officers create that to get more business from realtors. Let's face it, doing a pre-approval it used to be like half the game was pre-approval. Guys, now the name of the game is how do we get someone under contract? And so affordability options, also our rent versus own, helping first-time home buyers really understand the power of home ownership. There's a quote going on in the mortgage industry. I don't know if anybody has heard the date the rate, marry the house, divorce the rent. Whether you like that phrase or not, it's very common in the industry. And we really power that. Like, hey, understand that you can buy a home and get seller concessions and be able to marry the home easier in this market because sellers are willing to do concessions and work with buyers. And then showing like, hey, here's what today's rates are. But most economists are predicting at some point rates are going to go to 4.5%. So in a Mortgage Coach total cost analysis, you can really tell that story for the consumer, and you can show that entire picture for families.
Okay, right on. No, I like something you said. Date the rate, marry the home, right? And you also said, that it's really about getting them under contract, right? That's what today's market is. Okay, so really the last question I have for you is it is focused on today's lending landscape, right? We have to start thinking outside the box. We have to be better prepared to serve our members today, but not just years to come. Not just, and it's also for years to come, right? So how can Sales Boomerang and Mortgage Coach help a credit union navigate today's difficult market, but also better prepare them to serve their members tomorrow, a month from now, a year from now? How are you guys doing that?
So I think, right now I'm doing a lot of presentations and keynotes on how to survive today. And I think I shared like loan now strategies today while preparing for, let's face it, at some point rates are going to start coming down. Let's just say that could be end of year, that could be first quarter. And then we also need to prepare for spring home buying season. And so what we are doing right now is helping lenders, first of all, through data, making sure that they have our rate watch alert turned on, making sure they have our rate and term alerts turned on, so that when rates do start to come down, we can provide consumers with go from data to a presentation, and then making sure their loan officers really know how to bring affordability strategies to consumers with the spring home buying season. I think it's 70% of mortgages take place within the spring home buying season. So we've got a whole 1-2 punch around how to win and get loans today, and then how to prepare for rates coming down and making sure that you're going from data to dollars. And at the end of the day, you guys are credit unions, you serve members, and every time you serve a member, you're saving them dollars. You have incredible pricing, you have incredible financial programs, and we just want to help you guys help consumers make the best decision for them.
I appreciate that. Well, Dave, that's all the time we have for just you and me today. So thank you very much for your time. I truly appreciate it. And again, thank you for sponsoring today's session.
Hey, we love credit unions. We love helping families. Take care, everybody. Thank
Awesome,
you.
Dave. Thank you. Take care. Bye-bye. All right, let's get on with the show. So focusing on recent history, our industry is nowhere experiencing the highs it did when really just a short few years ago. Thinking back to 2022, because I'm a full believer that you need to think about where you've come from to establish where you want to go, and that's always been my mindset. So try and think back to 2022 and to establish some background for our conversation. Allow me an opportunity to talk about some few points that in many ways either describe this past year, or really we're still in it, but either describe this past year or possibly it may just be a list of events that have occurred. Okay. So again, I've already said it. The record volume we saw just a short time ago, it's safe to say long gone. So let's break down 2022. First up, we have this oldie but a goodie is one we keep talking about. So in order to contain inflation, the Fed has raised rates 6 times, and really they're projected to raise rates again in December by another 50 basis points. So that's one thing that's happened, and a good storyline for 2022. This year, in addition to that, this year we experienced some culture shock related to the speed at which mortgage rates increase. Now, they seem to plateaued in that low to mid 7s, but as a result, would-be home buyers have pressed pause on really their dream of home ownership. This means that loan officers are fighting tooth and nail for those few home buyers that are actually looking. And then that kind of takes me to home price appreciation. So we have home price appreciation, paired with, the aforementioned rates, combined with falling inventory, which by the way is at a quarter of what it was in 2008. All of this has prompted industry experts to revise their forecasts more times than we ever thought they would. It almost seems like you truly need a crystal ball to predict where we go from here. And this is all on the purchase side of our business. Don't even get me started on our refinances. These are almost long gone, non-existent. And borrowers are more likely to flock to a home equity than touch, their 3% first mortgage. Anecdotally, I guess it's a good time to be a second mortgage lender. And finally, I guess to kind of summarize 2022, with a focus on affordable and equitable housing, fair lending is getting really renewed attention, and credit unions are starting to dive into these practices due to really commentary coming out of the CFPB as well as the NCUA. Now, I don't want this webinar to seem all doom and gloom. I promise you, I don't. So let's focus on some positive notes. Perhaps there are some signs that our market is shifting, right? National home price appreciation continues to slow, so I guess that's a positive. It's slowing. Home buyer demand is up. Inflation might be improving. And really, as I think about today's session, and the biggest question I think we really want to get answered is, what do we need to do to come out of our current times and the next year better, faster, and stronger? Now, I did my best to keep this list somewhat short, and I probably could have kept going on when describing 2022, especially when it comes to all things legislative or regulatory. But, I'm being told we got to keep this around that 45-minute mark. So that brings me to my panel of experts, and I'd like to introduce everyone to them. First up, we have Chris Cully, a partner with Mayor Brown out of their Washington, D.C. office. Chris, welcome. If you could come online. Thank you very much. Chris, how are you doing?
Hi, thanks so much for having me.
Perfect. My pleasure. Next up, we have Bill Bodner, Chief Revenue Officer with Tabrasa and the Chief Market Analyst, with the Mortgage Market Guide. Bill.
Hello, buddy. Hello, my friend.
Wow. How are you doing, bud?
Doing good.
All right, good. And last, but certainly not least, Ron Vanberg, President with Ron Vanberg International. Ron, always a pleasure to see you.
You too. Where's my ACDC?
We had to cut it off. I'm sorry. Well, we probably could have kept it pretty low, but I think as we're talking, you won't be able to hear it. Anyways, everyone, welcome. Let's just dive right in. All right. So we're going to keep this simple, right? Because this is about really the New Year's resolutions for 2023. But, and again, I like the idea of us walking through what we've seen in order to kind of chart the path forward. So I'm going to ask all three of you the same exact question to kind of start off. Okay. And Chris, we're going to start with you. So here's the question. 2022 has been pretty interesting. If you could walk us through your thoughts, and if you could provide a quick overview of things really you feel have taken us by surprise. Chris.
Well, again, thank you for having me. I'm thrilled to be here and thrilled to speak with ACUMA and its members. But so taking you through 2022, as Peter mentioned, I'm a lawyer, so I've been looking at things from kind of a regulatory and legislative lens. I mean, 2022 wasn't necessarily a huge year for mortgage regulatory actions. It seemed like the NCUA and the CFPB were focused on other products or other processes, whether it was auto lending and dealer markups and gap insurance and so forth. But having said that, it's clear that the agencies in 2022 were laser focused on fair lending initiatives and on equitable home ownership, and really all the agencies from the state level to across the federal government were focused on trying to ensure in a real affirmative way that credit unions and other mortgage lenders were trying to address systemic biases in mortgage lending. So it's not just enough in 2022 to focus on not discriminating, to focus on refraining from treating protected classes differently. The agencies were requiring mortgage lenders, and including credit unions, to go out, compare yourselves to others in your marketplace, figure out if you're serving all aspects of your membership and of your community, and figuring out how you can do more and better outreach, more and better advertising, more and better penetration of those underserved borrowers to make sure that no family is sort of left behind. So that was 2022, I think, in a regulatory nutshell.
So anything take you by surprise by chance?
Well, all the things you mentioned took me by surprise. I certainly didn't expect
So I did a good job then, right? I did a good job.
Pardon me?
I did a good job summarizing them.
Yes, well, and I'm not the economist on the panel, but I was surprised at how the economy had an impact on independent mortgage companies. I mean, we've heard about layoffs, about some shrinkage in the providers in the mortgage market. Thankfully, not surprisingly, credit unions are well positioned in this environment. But I'll leave that to the experts on the panel. From a legal and regulatory perspective, my biggest surprise is, and you may have heard, the Fifth Circuit, which is an important appellate court in Texas, Louisiana, Mississippi, found that the CFPB is unconstitutionally appropriated, unconstitutionally funded. So if that's the case, that means that all the rulemakings and enforcement actions that the CFPB has undertaken, for which it spent money, obviously, are invalid. What does that mean? We might think that's great news because suddenly all the things that we've been annoyed about with the CFPB are gone. But that also means things that we like are gone. We've gotten used to QM. We've gotten used to TRID. Does that mean that suddenly this is all off the table? And one other thing is that all the federal banking agencies are funded in a similar manner. So to the extent the CFPB is unconstitutional, what does that mean for all of our regulators? So that was a big surprise. I didn't really expect such a huge decision. We'll hear what the Supreme Court has to say, but that's what took me by surprise this year.
That was a good one. I think that one, when the news broke on that one, I guess 3.5 weeks ago, probably at this point.
Yeah.
I don't think there was a single jaw that had not hit the floor, right? That was a big one. We spent a lot of money on getting compliance up and running. So a significant amount of money getting our compliance controls up and running, and for all to come out and pretty much say that was all for nothing. Big surprise, right? Big shock. Okay, perfect. Thank you, Chris. I appreciate that. Ron, All right. So as the sales guru, all things sales, if you want to sell a pencil to anybody, Ron could teach you to do it. We went from a refi market to really no refi. Do me a favor, from putting your sales hat on, right?
Okay.
Kind of walk me through 2022 from your viewpoint. What took you by surprise? Give me an overview from that whole idea of sales, growth, building business, etc.
Well, needless to say, everybody got shocked by what happened in 2022. The biggest surprise to me, being in and around the mortgage industry since 1984, is how far and how fast interest rates rose. The fact that interest rates went up didn't surprise me. I think it surprised a lot of people who have not been in the industry very long. But I can think back to 1987, when it was, I don't know if it was Black Friday or Black Monday. I always get whichever day it was confused. And interest rates rose about 1% in 8 hours. And I remember being an originator, and I lost my entire refi pipeline in an afternoon because none of it was locked. And I still have, even though I'm not originating anymore, I still have scars from that. So when interest rates first bumped up, I wasn't surprised at all. When they really kept on going, that caught me by surprise, and obviously caught the entire industry by surprise. I think, and I am not a predictor of markets. That is not my forte or what have you. But for years, and this is the joke I always make. I go, if you make a prediction long enough, you're going to be right. And for years, I've been saying rates are going to go up. Rates are going to go up. And I said it through the whole pandemic. And guess what? In January of 2022, I was right. It only took me about 3 years to get it. But but being serious is, it surprises me, but it doesn't, as to everybody knew it would happen. Nobody knows when, and nobody knew to the degree. But what surprised me especially is how many mortgage companies they knew it was coming. There's nobody ever who said that they didn't expect rates to rise at some point, but they did nothing to prepare for it. It was like, we know, yeah, we've got to prepare for it, we know. But the money was flying in at such an incredible speed with refinances that the need for focusing on it was not there. And so what surprised me, though, is that there are enough people in the industry, both in credit unions and also more so in IMBs and banks, that have been through this before. And they didn't learn the lesson. They didn't push hard enough to get their salespeople not refocused, because you're not going to give up on all that business that's just coming in the door, but to not just ignore it. And then when they bumped up, what did surprise me is how little prepared. It's one thing to think about it in advance, but it was another thing how little prepared they were even to adapt.
Right.
How, from a training, again, my sales hat, my training hat, how the enormity of the lack of skills that people had to go out and try and develop purchase business. And I share this story. I have a client who works for an independent mortgage banker, but loves to help agents with open houses. And he's doing open houses with agents almost every weekend. Now, I've been in the business since 1984, and he told me not once, but twice, he saw loan officers, when rates bumped up, come into the open house and give a realtor a rate sheet. And I said to him, I go, is this 1985 or something? I'm like, I don't even know how you would print a rate sheet anymore. But
they're still out there, Ron. They're still out there.
Okay, if they're still out there, and I said to him, I go, you've got to be kidding. He goes, no. And he goes, it didn't happen once, it happened twice. So that to me is just, I'm just shocked at how few companies really understand what they need to do to weather this market. And they're still behaving in a similar way, that many of them are still not doing enough about it. And, or I don't know if it's because they don't know what to do, or there's all sorts of reasons.
Sure.
But
Sure.
but the surprise to me is just there's a lot of pain out there, yet people are remaining, industry leaders and originators are remaining frozen, and they refuse to do what it takes to get through this. And I look at it this way, because I love simple. Are people buying houses? Yes. Are people selling houses? Yes. Then interest rates don't matter. Your
Right.
skills to take advantage of the market matter. And I'm just surprised by how many people don't understand that or don't want to understand it because they don't want to put in the time, effort, and energy.
That's right. All right. Thank you, Ron. Thank you, Ron.
Thank you.
Yeah, I'm a quote a wise man. A wise man once said, "Jobs buy houses," and that wise man actually was Bill Bodner, which actually will take me to Bill. That's a perfect segue, right? Sorry, Bill.
Yes, sir.
You are very passionate about all things economics. You're open about it, which I think we all love.
Yeah.
Do me a favor. Summarize 2022. What took you by surprise? Go for it.
Yeah. I mean, I think Chris and Ron hit on it a little bit, but the biggest thing I think we all learned in the mortgage space, and it shocked me to a degree, was how tethered our space is to the Fed. And last year, we're almost coming on the anniversary, by the way. November 22nd last year was when Fed Chair Powell got renominated by President Biden to become the Fed chair again. 8 days later, on November 30th, he said, remember that inflation we've been talking about, that high inflation, it's going to be transitory. 8 days after being renominated, he said, that word, we probably got to retire that. And that bond buying, we're going to have to stop that. And oh crap, we got to stop it quick. And so that set off, Ron talked about how people didn't see it coming. We saw it coming. That was a game-changing moment. And up until about, I don't know, a month ago, I think it erased like $48 trillion worth of bond and stock wealth around the globe. And it was all triggered by that moment in November. And so what it did is it kicked off what part of the uncertainty I created is that kicked off the uncertainty and the volatility that we're still living through today in the mortgage space. I'll be on with another credit union here in another hour, and they want to talk about liquidity and all these things, and it's all stemmed from that moment. And what made it even worse was back then when they talked about inflation, they said it was wrong. They continued every 3 months telling us, giving us forecasts, and every 3 months, to Ron's point, they're supposed to be the smartest guys in the room. And they've been getting it wrong consistently every 3 months and looking at backward data and forward data. So it's been a mess. So I think the biggest thing that I see looking back was that, the Fed really blowing it on inflation and then jawboning the market. Remember, we did those events together, the workshops, and we talked about that. They were talking tough. They haven't even raised rates yet, but they were talking tough, and it just made things such a nightmare. And they put a target on our back, right? Part of the problems that we have in mortgage, I go back to that time in early in the year when they said, oh yeah, you know what? We have this big balance sheet. We're going to shrink this thing. And, we don't want any mortgage-backed securities on it. That's like, and by the way, none of that's happening right now, but they set all that stuff in motion. So I think when we look back, that was one of the big surprises. And, the other big surprise, I think when this chapter is written on our economy and as it relates to inflation, there's many causes to it, but I think we really misunderstood the importance of energy. It's everywhere. It's everywhere. I mean, we got inflation raging across the pond in Europe. And, if we were able to help them by producing supply, I think we'd be in a much better spot. So I think those are the couple of things I'm thinking about.
All right, good. Sorry, let's pivot to and all three of you, thank you very much for answering that. Let's go to the next question. And it's really that look ahead. Okay. So Bill, I'm gonna start with you. Okay.
Sure.
Yeah. You had the pleasure of going last this last question. You're gonna go first this time. Okay. So I'm gonna preface this question with this. A recent report by JP Morgan Chase showed that they were predicting that the Fed would raise rates in February and March of next year, and they would do it by 25 bips. Okay. And again, this is all in that continued effort to battle against inflation, right? At the same time, the same report by JP Morgan Chase said all this is going to do is tip the scales into a mild recession. Okay. So Two-part question. As we look to 2023 and really, I guess, beyond, give me your thoughts on really, JP Morgan's report and that whole 25 bips and the need to raise rates 2 more times next year. And really, what does a credit union need to do to kind of start preparing for that from an economic standpoint, and whether it's pricing for their portfolio appropriately, prepare themselves to navigate that mild recession?
Yeah. Okay. That's a good question. First off, I would remind everybody to Ron's point again, that, I'm old enough to remember 2018, 2019, the just similar kind of market. Fed was raising rates, a rate hiking cycle. They raised rates 4 times, wanted to shrink the balance sheet. And they did that one rate hike in December of 18, and the stock market drove off a cliff, didn't like it. And everybody, the Fed, Bank of America, Goldman, all these big houses said the Fed's going to raise rates 4 times in 2019. 6 months later, they were cutting rates. They never even got another rate hike in. So these things, even the Fed has said many times, don't follow the dot plot, right? It's not a forecast. So listen, what I would remind everybody here is that we're selling long-term rates. Long-term rates in our eyes has already crested. I think 4.23 in a 10-year note may not be taken out again. The inflation, as you mentioned early on, seems to have rolled over, right? And you can't just say, oh, a couple of rate hikes is going to create a recession. The bond market is already telling the Fed, guys, you're going too far. I mean, you hear things like the yield curve inversion, like the 2 and a 10-year note. It's at the widest level since like 1981. Even a 3-month bill, Peter, is yielding more than it. So the bond market, who I think is the smartest person in the room, is already telling the Fed, Morgan, and everybody, you're all wrong. You have to stop soon. And so if I were in a credit union's shoes, I would be thinking about, some of the sales skills that have to be kind of regenerated. There was a lot of sales atrophy when money was falling from the sky. Now we got to get out there. We got to get our folks financially literate, and we got to get them primed to go out there and take the business, because to Chris's point, the credit unions are in a really good spot. I have a lot of friends and clients in the independent space, and it's not that much fun out there. And as for a lot of different reasons, but I think the credit unions are uniquely positioned to win in this market. And I think it's changing right in front of us. Remember, in a recession, rates don't go any higher, long-term rates. Home prices stop going up really quick. And now we just got to hope. I mean, the one hope that we all have is that we don't get too much unemployment, because as we said, jobs buy homes. We get a little bit of unemployment and things work out. This story can change very quickly to the positive.
Okay. Thank you for that. A couple things, right? In a nutshell, you said, but also piggybacking off something Ron said, we almost have to get comfortable with selling that 7% interest rate.
Not that comfortable.
Well, but let's get comfortable and perfect doing it, because if we can sell a 7% interest rate, we can sell a 6, and we can sell a 5, right? And what happens after a recession? Rates fall, always.
That's right.
Right?
That's exactly right.
So, Bill, always appreciate your insight. All right, so coming back to Chris, and I don't have as long of we'll say lead in for your question. 2022 was fair lending. Will 2023 be something else from a regulatory standpoint?
I don't think it'll be something else. I think that will still continue to be a focus. And, credit unions always do a great job in ensuring that they're serving all their members. But there is some research that's shown that still, even among credit unions, there are higher denial rates and worse pricing outcomes for minority borrowers, even when controlling for credit risk. So the NCUA has said that it will, 1, be paying more attention to consumer financial protection issues, and 2, it will increase resources for fair lending supervision. So, and of course, the CFPB has a flame under its fair lending enforcement nest as well. So even as the economy stays a little bit tight, there's going to be a continued focus on equitable lending products and practices and outreach to this underserved section of home borrowers. But I do think there will be some other focus as well. I am not the best predictor, but I do think that one big issue for 2023 will be appraisals. And I've spoken to this group in the past about the seemingly intractable problem of bias in appraisals, whether it's intentional, accidental, systemic. It's there. And of course, there's a big interagency task force. We're expecting any day now an interagency rulemaking on automated valuation models, which, you know, there's a hope that we can use technology to help us in this sphere. There's certainly a focus on how can mortgage lenders incorporate reconsiderations of value, appeals for valuations that seem to come in much lower than expected, or in certain neighborhoods where, you know, there may have been historic or systemic undervaluation. So I think appraisals will be a big focus. I also think that particularly in the mortgage sphere, that servicing compliance will be important. You know, hopefully the recession that it sounds like some are predicting will not be, you know, a sharp drop, but we've had such great luck with default rates. But that could change. And I think that the regulators are looking for mortgage servicers to make sure that they can focus on their loss mitigation programs in a fair and compliant way, and that they're focusing on the fees that they're charging to mortgage borrowers, because as you've heard, the director of CFPB really talks about junk fees a lot. And in the mortgage space, he's talking about fees like speed pay fees, where the borrower has to pay an extra fee to get that, to get the payment over the phone. Make sure that you're telling your members about all the types of payment options, including ones that don't cost a fee. Also, refinancings. The CFPB thinks that there are obstacles to refinancing. I'm not sure personally that there are these days that the obstacles are particularly regulatory. They're a bit more economic. But I do think that we'll hear about that either under a QM rulemaking or otherwise, a focus on making sure that that borrowers are able to refinance. So that's what I think.
Of course, assuming that the ruling that occurred in Louisiana 3.5 weeks ago doesn't get much more traction, of course, right? Assuming, right? And really, to summarize, you know, fair lending will continue to be an issue, and the talks, you know, what we've really just started talking as we'll say an industry as a whole, just started talking about the appraisal biases, right?
Yeah.
And you feel as though that's really going to start picking up a lot more traction next year. But on top of that, if we do start tipping the scales into a recession and unemployment rates start rising, the focus is going to be on servicing.
Right.
Correct? Is that a good summary?
That's my thought. Yep.
Okay, perfect. Love it. All right, Ron, coming to you.
Yes, sir.
All right, as we saw in 2022, you know, if you weren't nurturing your referral sources in 2020 and 2021, they were quick to forget about you. All right, so again, thinking about 2023, it's refinances are gone. How can we get back our referral sources in 23? What do we need to do?
Well, to take a step back for a second is you absolutely, a lot of people ignored the realtors and all the other different referral partners. But one of the bigger challenges working in the credit union space and also working with independent mortgage bankers and banks is that of the three, you know, if we say banks, IMBs, and credit unions overall had the least number of relationships with referral partners, if we're talking about realtors.
Sure.
They have been extraordinarily member focused and have done incredibly well for not 2 years, but for decades, or pretty much the existence of CUs. So there's never, and I don't want to paint every credit union with the same brush, but as a sector of the lending area of the industry, there's always been the greater focus on membership, which is fine.
Retention, right?
Retention, correct, but little to no attention on realtors and referral partners. But after being that is said, I don't really look at it necessarily like how do they win them back, although the question is relevant. I just say, how do we win them?
Okay.
Because if they didn't have the relationships, if they didn't focus on it, well, then you have to get in the trenches with the IMBs and the banks. But there's, credit unions, and it's one of the reasons why I love credit unions and I love working with them, is because it's not hardcore sales. It's, we're a family, we're members, we treat you differently. And it's, the way CUs engage with their clients and they engage even with the communities is very different than the way everybody else does. But what they need to do is know or learn how to package that
Magic sauce.
That magic sauce, that different feeling, and get out there and develop relationships using that, because that's going to differentiate them. First of all, than your standard traditional LO. I mean, right now, what's happening is in banks and IMBs, but especially IMBs and brokers, and I work with them and have great relationships with them. Many of their originators, they're going out, but they're going out and they're desperate.
Yep. And
a desperate salesperson can be spotted a million miles away, because what they're all about is, how do I get business? How do I get business? How do I get business? Where a great advantage for credit unions is, how do I give value? How do I help you? It's a different mindset, but the credit unions have to know. I can't raise my other arm, but I was going to say how to put that package. Every so often I try to do it, and it hurts, and it reminds me. They have to know how to package that so the audience is receptive. And that's where I feel a lot of them are struggling, which is where they really need to learn. Everybody says, oh, we got to learn how to sell. Yeah, but there's a lot of ways to sell. There's not one way to get business. What you want to do is you want to sell to your strengths. And as long as you know how to message that, you can create a huge advantage for yourself. And that's what I think really credit unions need to do.
I like that. That's a good one, Ron. That's good. All right. So let's go, just looking at the time, let's go final questions before we do, parting words. Ron, I'm gonna start with you. So we talked about 2023 and what we need to do to get back in 2023 to kind of navigate this market. But let's really think about that resolution, because that's why everyone's here. That's why we had people sign in, because they want to hear your thoughts on a New Year's resolution for credit unions. If there was one or two things that a credit union could and should be doing in 23 to come out ahead, what would that be? From again, you are the sales expert. What would that be? Or what would they be?
Okay. Two things come to my mind with that question. One, we don't know how long this storm's going to last, but we don't think it's going to end in 5 minutes.
That'd be great if it did, by the way.
It'd be great if it did, but I don't believe it's going to. And I always tell people, I go, if you want me to make a prediction, whatever I tell you, do the exact opposite and you stand a better chance. So I own that I stink at it, but I don't think it's going to end quickly. And the Fed seems pretty much hell-bent on making sure it doesn't end quickly because of the way they're mismanaging what they're doing. So I think we can all agree on that.
I think you and Bill are on the same page in many ways.
Totally. I think we're just I think Bill and I are on the same page. I think we're just both putting it in a G format when we'd love to put it in a real, we really want to say what we think. Bill, I don't want to speak for you. I'm just speaking for me.
You have to be a paying member of Mortgage Market Guy to get the full version.
The art builder version. Exactly. But the two things, one is in times like this, leaders of credit unions have to manage the mindset of their teams. Because when people get into a negative mindset, which right now there's a lot of negativity, when people aren't busy and now they're uncertain if their jobs, and I'm for the first time hearing that credit unions are laying people off, which is like almost something unheard of. Yep. So there's a lot of fear and anxiety. And so I believe that leaders, it's key to manage the mindset, be motivational, be inspirational, to their team. And I want to just digress for 1 second, because I think this is really relevant. I was doing a coaching call with a client of mine last week, and she's been a client of mine for years and does well. And she was talking to me about a conversation she was having with a borrower. And she said to the, I was coaching her through to improve it. And she goes, yeah, and when I told the borrower said rates are high, and she goes, yeah, and I said, I know that they're high. I said, stop it. And she goes, what? I go, rates are not high. I go, rates are rates. I go, the moment you agree with that, you're putting yourself in a negative mindset about interest rates, and you're reinforcing the borrower's mindset about rates.
Mhm.
I don't go into the story of, okay, I sold rates at 18%, because it's irrelevant, because it would be like my parents telling me why I went, this is what happened in the Depression. I have no relationship to that. So if I have no reference, that story doesn't mean anything. But here, everybody here has experienced 3%, 4%, 5%, 6%, 7%, et cetera. So rates are rates. The question is, are people buying and selling? And that's the motivational message that has to be reinforced, that in times of challenge, in times of adversity, there's always opportunity. So that's the first message. The second message is after you've delivered that there's always opportunity, you have to go to work to take advantage of it. And that's where the training, the guidance, the mentorship, the real plan, the real structure has to be put in place. And because, going back to the previous question, credit unions have not been very sales focused, they've been more membership focused. Again, not critical of it. There's a lot of leaders that just don't know how to do it.
Right.
Because they've never had to. And I think now is the time, not just because of the current market, but if you really adapt the balance of the family, the membership, and sales. So it's not one or the other, but combine them together and really work to foster that. Not only are you surviving what's going on now, not only are you going to thrive and grow with what's going on now, you are going to be positioned to take tremendous advantage of the market, no matter where it goes. I remember last year at the MBA convention, they said that credit unions represented 7% of all originations, and that number seemed to stay consistent for over a decade, if I remember correctly. It went on
Between
and on.
5 and 7.
I'm sorry, between 5 and 7.
Mhm.
It is so easy for you to dial that higher. It really, really is. Has nothing to do with the market. It has to do with shifting just a little bit in how you're moving your people and motivating your people and training your people. And that number grows.
All right, I like it. I've been saying this more times than I can count, and I'm sure many of you have heard me say this. Next 3 to 5 years, the years of the credit union, we go from that 5 to 7% to that 15 to 20%. I'm telling you, it's possible.
I agree 1,000%. They just have to make a change.
Okay, I love it, Ron. Thank you so much.
Thank you.
All right, Bill. I don't know how you follow that, but I'm gonna ask you to follow it.
Yeah, it
Give
was
me
good.
that 1 to 2 things that a credit union needs to do. Give me their resolution right now.
Yeah, I love the sales stuff that Ron shared, because I there's such opportunity, and we talk about moving the needle. I didn't realize that number, that 5 to 7%. I think a couple of things. We work with a lot of credit unions, and one of the challenges that many talk about is how do we get a bigger capture rate of just our members? We're doing 5 to 7%, whatever that is.
So real quick, here's a good number for you. And I'm sorry to interrupt you.
Yeah, please.
The average credit union has about only 2% of their members actually have mortgages with them. 2%.
It's ridiculous.
That's the average.
So
if you're at that 5% for your membership, you're blowing the doors off.
No kidding. Okay, so I mean, obviously, some of the stuff that we talk about, like you have sales skills. I do think that even the stuff that we talk about, you and I together, like the financial literacy, I think that creates incredible opportunity to help close opportunities that are in front of you, right? Ron said you lose more than you gain. I think that helps you with your win ratios. But then the outside business, another area where, again, we talk about a lot of credit unions where they come up short is how do we get that outside business? How do we get those partners? And you don't need to work with 600 realtors. Become really good friends with the people that do the business. There's going to be a washout in the real estate side, right? Like the refinance people in our space. So there's going to be a thinning of the herd. And, approach those realtors with great sales skills, with higher financial literacy. And you don't need many. You need a few that you can go deep with, that you become real good friends with. And I think, build on that membership thing. We talked about Dave Savage at the beginning, the data, right? You have things that you can do with your memberships to bubble up opportunities, and then hit them with great sales methodology and, credibility with some knowledge. And I think might be a good key for success next year.
So when you said financial literacy, you're referring to are you referring to the loan officer understanding
loan
what's happening in the
officer.
market? Okay.
The
Okay.
loan
Just
officer
wanna make
needs to speak to a member. If you want to go bring to a realtor, you need more than just great sales skills. They're going to want that, but they're going to want the brand, of course. But then also, like, you're a problem solver. You know what's going on. Have an opinion or a perspective. You don't have to be a forecaster, but at least be able to refute some of the junk that's getting thrown on the media. Heck, and you can have a field day with the Fed. What they're saying, they say something every day. You combat. So I think there's a great opportunity to provide some light and optimism and just kind of, a position, right? I think that's the big thing.
Awesome. Bill, thank you. Chris, coming to you. Give me a New Year's resolution for credit unions for 2023, please.
Well, it's so optimistic to think forward, and then you kind of end on this compliance note.
We did it on purpose.
I know, it's like, so welcome to your scolding elementary school teacher. But I do think that, and you won't be surprised by my answer, but it's really hard to focus on sort of fundamentals of compliance when your refinances are flying off the shelf. But to the extent that you have some time now, it may be a good time to just take a step back, focus with fresh eyes on risk assessments in the compliance arena. Take a look at your policies and procedures, make sure that your compliance function is actually functioning, that you actually have the infrastructure in place to ensure things are going to speed up again, and you won't have the time to look at these things. Take a look at your compliance function and see if there are any holes that need to be plugged up. As the others mentioned, take a look at now's a good time to just take a good hard look at your HMDA data and your membership demographics and your product offerings, and see if there is room for improvement or creativity or special purpose programs. Again, I know that you've got plenty on your plate still, but to the extent that you can, pay some extra attention to compliance and take a step back. Now is certainly the time to do that. So.
Don't worry, Chris. I was waving my finger for you, just so you didn't have to.
Yeah.
So I like what you said about really mining your HMDA data. That way, you can figure out what your major demographics are, but two, where you're missing, right? I think that's really key, especially as you go into 2023. That's a great New Year's resolution. Know who your borrowers are, right? Where they come from, who they are, because as you said, fair lending will continue, right? Okay, perfect. All right, Chris, I'm gonna come back to you. Listen, we've gone a little bit over. That's okay. Krista won't yell at me too bad later, I promise. Give me some final words, Chris. Any final words?
Well, again, I hate to hark on the compliance and readiness, but I guess one other thing I would bring to the audience's attention is I understand, I spoke with board member Hopman earlier this year, and he indicated that one of his goals is to improve the examination process, to bring more transparency and frankly, agency accountability to the exam process. So as you're looking at your compliance function, another great exercise is sort of exam readiness. Try to get organized in advance. Try to discover where any of your compliance weak spots may be and make a plan to address those. Then you'll be ready when the examiners come to visit and make that process go more smoothly. So I'm not sure if that's so profound, but I do think that's my last thought.
Perfect. Thank you. All right, I'm gonna come to Bill. Bill, final words.
Okay. Well, just really fitting, a kind of culmination of a lot of the things that were said, and talking about, an economy that's slowing down, may or may get to a recession. Hopefully it's nothing too crazy that might be Fed induced. But this is a button my buddy Todd Duncan gave me when I was out speaking at his event, and I give everybody to think about. Rumor is we're in a recession. I'm not participating. Don't participate.
Okay. All right, Phil.
Yeah, I'm opting out. I'm just going to opt out.
I'm not participating. I'm going to sell. I'm going to win. I'm going to be positive. I'm going to get my partners. I'm going to do all the things that, while everybody's crying in their beer, trying to figure out where they're going to get their next loan. Get your team out there and get it done.
That's right. Thank you, Bill. I appreciate those final words. Ron, please, final words.
Final words is really simple. There's always opportunity, no matter what's going on. In order to take advantage of those opportunities, change the questions, and start asking questions like, how do I take advantage of what's happening in the market today? How do I take advantage of what average and typical loan officer and lenders either won't do or are unwilling to do? You dive deep into answering both those questions, you will come up with answers and ideas that the average and typical won't, and therefore you will not be average and typical. You will always have a competitive advantage.
That's awesome. I like it. Thank you very much. Well, it's sad to say we are approaching time for today. And so I guess we have to wrap up. The three of you have truly given all of us valuable insight, and I think we're a little bit better prepared to go into 2023. So for that, I thank you. Before I end today's session, just a few housekeeping things to kind of wrap up. Thank you for taking time today to spend it with really the four of us. I hope that you walk away better prepared for 2023 and that you enjoyed the insight that our panel of experts provided. And I guess the last quick reminder is, be on the lookout for some really awesome events coming in 2023. The team has worked extremely hard to really point us in a direction that I know you will enjoy that ACUMA is going. With that being said, I hope everyone has a great day or enjoys the rest of your day. And if I don't talk to you beforehand, please have a safe and happy holiday season. Bye.